Another day, another story. Welcome to NK Switch. Let's know about stock market and how it works. The stock market, also known as the equity market or share market, is a platform where individuals and institutions can buy and sell ownership stakes in publicly traded companies. When a company goes public by offering its shares for sale to the public, it lists them on a stock exchange. Investors can then buy these shares, which represent a fractional ownership in the company. Here are some key points about the stock market. Shares, stocks. Shares represent ownership in a company. When you own shares of a company's stock, you become a shareholder, which means you have a claim to a portion of the company's assets, earnings, and potential future growth. Stock exchanges. Stock exchanges are organized platforms where shares of publicly traded companies are bought and sold. Some well-known stock exchanges include the New York Stock Exchange, NYSE, and the Nasdaq in the United States, the London Stock Exchange, LSE, in the UK, and the Tokyo Stock Exchange, ZEI, in Japan. Trading. Shares are traded between investors through brokerage firms or online trading platforms. Investors can place buy or sell orders for specific stocks, and these orders are matched on the exchange. Price determination. The prices of stocks are determined by the forces of supply and demand. If more people want to buy a stock than sell it, the price typically goes up, and vice versa. Investment opportunities. The stock market provides opportunities for investors to invest in companies they believe will perform well over time. Investors can potentially benefit from both capital appreciation, increase in stock price, and dividend payments, a share of the company's profits distributed to shareholders. Risks. Investing in the stock market carries risks. The value of stocks can be volatile and may go up or down based on various factors such as economic conditions, company performance, industry trends, and global events. Indices. Stock market indices, like the S&P 500 or the Dow Jones Industrial Average, are used to measure the overall performance of a collection of stocks. These indices give an idea of how the market as a whole is performing. Long-term versus short-term. Investors can have different investment strategies. Some investors aim for long-term growth and may hold onto stocks for years, while others engage in short-term trading to profit from shorter price movements. Regulation. Stock markets are regulated by government agencies to ensure transparency, fairness, and investor protection. Regulations vary by country. Role in the economy. The stock market plays a crucial role in the economy by providing companies with access to capital for expansion and growth. It also enables individuals and institutions to invest and potentially earn returns on their investments. Remember that investing in the stock market involves risks, and it's important to do thorough research or consult with financial professionals before making investment decisions. The stock market refers to a marketplace where buyers and sellers trade ownership shares in publicly traded companies. These ownership shares are called stocks or equities. The stock market serves as a platform for companies to raise capital by selling ownership stakes to investors, and for investors to buy and sell these ownership shares in the form of stocks. Companies can go public by offering their shares through an initial public offering, IPO, which is when they transition from being privately held to becoming publicly traded on a stock exchange. Once a company's shares are publicly traded, investors can buy and sell these shares on various stock exchanges, such as the New York Stock Exchange, NYSE, or the Nasdaq. Investors purchase stocks with the expectation of benefiting from the company's growth and profitability. If a company performs well and its value increases, the value of its stocks can rise, allowing investors to profit by selling their shares at a higher price than they initially paid. Conversely, if a company's performance falters, the value of its stocks can decline, leading to potential losses for investors. The stock market plays a crucial role in the economy as it provides companies with access to capital for expansion and development, and it offers individuals and institutional investors a means of investing their money to potentially earn returns over time. However, investing in the stock market carries risks due to the volatility of stock prices, market fluctuations, and other factors that can impact the value of stocks. Investors use various strategies and analysis techniques to make informed decisions about buying and selling stocks, including fundamental analysis, examining a company's financials and business prospects, and technical analysis, studying price patterns and market trends. It's important to note that investing in the stock market involves both the potential for gains and the risk of losses, so careful consideration and research are recommended before making investment decisions. The stock market is a complex system where individuals and institutions buy and sell ownership shares of publicly traded companies. It provides a platform for companies to raise capital by issuing shares and for investors to buy and sell these shares as a way to potentially earn profits. Here's how the stock market generally works. Companies go public. Companies looking to raise capital for various reasons, such as expanding operations or funding new projects, can decide to go public. This involves offering ownership shares, stocks, of the company to the public through an initial public offering, IPO. In an IPO, the company's shares are listed on a stock exchange for the first time. Stock exchanges. Stock exchanges are platforms where stocks are bought and sold. Examples include the New York Stock Exchange, NYSE, NASDAQ, London Stock Exchange, LSE, and Tokyo Stock Exchange, ZE. Companies that meet certain requirements are listed on these exchanges, making their stocks available for trading. Buying and selling. Investors, including individuals and institutions, can buy and sell stocks through brokerage accounts. When you buy a stock, you're purchasing a share of ownership in the company. The price of a stock is determined by supply and demand dynamics in the market. If more people want to buy a stock than sell it, the price tends to rise, and vice versa. Stock prices. Stock prices are influenced by a variety of factors, including the company's financial performance, industry trends, economic conditions, geopolitical events, and market sentiment. Analysts and investors use various methods to assess the value of a stock, such as fundamental analysis, examining financial statements, and technical analysis, studying price patterns and trends. Market orders and limit orders. When placing a trade, investors can choose between market orders and limit orders. A market order is executed immediately at the current market price, while a limit order is placed with a specific price at which the investor is willing to buy or sell. If the market reaches the specified price, the order is executed. Market indices. Stock market indices, such as the S&P 500 or the Dow Jones Industrial Average, represent a collection of stocks that are used to gauge the overall performance of the market or specific sectors. These indices provide insights into the market's trends and direction. Volatility and risk. The stock market can be volatile, with prices fluctuating frequently. Prices can be influenced by unexpected news, events, or changes in investor sentiment. Investing in stocks carries risks, including the possibility of losing money if stock prices decline. Long-term investment and trading. Investors have different strategies when it comes to stocks. Some investors are focused on long-term growth and value investing, aiming to hold stocks for an extended period to benefit from potential appreciation. Others engage in short-term trading, attempting to profit from short-lived price movements. Dividends and capital gains. Some companies distribute a portion of their profits to shareholders in the form of dividends. Additionally, investors can make money through capital gains, which occur when they sell a stock at a higher price than they paid for it. Regulation. Stock markets are heavily regulated to ensure fairness, transparency, and investor protection. Regulatory bodies, such as the U.S. Securities and Exchange Commission, SEC, enforce rules that companies and market participants must follow. It's important to note that investing in the stock market involves risks, and it's advisable to conduct thorough research or consult with financial professionals before making investment decisions.